Hi, everybody, and welcome to the 2023 presentation of Dirty Little Secrets. I'm Justin Carlson. I'm the Chief Strategy Officer here at East Daley. Happy to walk you through this and get into some of the content that we expect to see, the dynamics we expect to see play out next year. So with that, I'm going to jump right in real quick. For those of you that are new to us or just new to East Daley or maybe for the first time hearing one of these DLS or even first time talking to us, I wanted to just walk through a quick, 10-second version of East Daley. And East Daley is very much infrastructure focused, and we dig really deep into the details to understand how our volumes, how our dynamics progressing across the commodity markets, particularly oil, gas, and NGLs. And then ultimately, how is that fed by the upstream and how is that impacted by downstream dynamics? So we're that sort of linchpin, as the midstream industry always is, that linchpin connecting supply and demand market dynamics. And then in the upper right-hand corner, you can see one of the ways in which we do that to get to more granular answers is by also digging deep into the financials to figure out what are the financial outcomes that come from connecting those volumes, from moving down the value chain, and ultimately, what does that mean for the players in the industry? So with that, I'm going to dive into the content. We're going to have three presenters today, myself. We'll also have Ajay Bakshani, who is going to dig into NGLs towards the end of the presentation, and then AJ O'Donnell, who's going to cover the middle ground there with crude markets. We've got a lot to cover today and a short time to do it. So what I would encourage is each one of you, and we recognize this, that each one of you has different takeaways that you might glean from this content. We'd love to discuss those takeaways, to apply this directly to your businesses. So to the extent that some of this content looks really interesting to you, but you want to dig deeper, reach out. We're happy to do more of a one-on-one discussion with you. In fact, we really love to do that. It's part of our service. It's part of the value that we personally get in helping you guys progress your businesses forward in this environment. So again, we're going to touch on the surface of a lot of these things, and we'd be happy to do that in person in your offices or over the phone at a future time. So with that, let's dive into this executive summary, some key takeaways. We'll then head into gas. Following that, we'll go into some crude oil, and Ajay will wrap us up with some NGLs. So, the first thing that we wanted to talk about in this top bullet is, I don't know that it's a mystery that the midstream is growing global and that overall U.S. energy security is being exported across the world, right? So I don't know that that's necessarily a mystery. What's really interesting about 23 and 24 is this dynamic that we think is going to exist where there's a bit of a misalignment. It's a timing issue of we're building infrastructure, we're growing production, but yet not all the demand side dynamics are following suit in as quick a fashion. So from that perspective, we think that the markets are in for a bit of a bumpy ride. And so we are closely watching that and going to monitor that going forward. And from a natural gas perspective, the biggest thing that we expect to see is this very mismatched growth of production relative to demand. So from that perspective, we all seen there's a massive amount of LNG demand coming online. We see 17 BCF, but that starts around in 25 and progresses through 30. In the interim, rigs have been increasing, infrastructure is coming online. Producers are guiding to higher growth in 23 without necessarily that big burst of demand side pull. We've just got the supply side push. So that's where this unconstrained, that underlined title there, unconstrained, we see the U.S. gas production would grow 5 BCF 22 to 23, and that's a year-end number, so year-end 22 to 23. If the demand side were there. And that's an issue we want to talk about and explore a bit deeper as I get into the content here is there is a challenge there that's going to impact basis markets, that's going to impact infrastructure, and that's the bumpy ride in that gas. On the crude side, one of the big dynamics we're talking about or looking towards, at least in the short term in 23, is that this is sort of the bottom, and that there's a lot of room to grow. So we've been growing production. We expect rates are going to start to push up as pipelines start to fill. We've got inflationary pressures that AJ is going to get into. They're also going to drive rates higher. As we talked about at the very beginning, everyone's headed to the coast, so we expect that utilization on pipelines moving towards export terminals is going to continue to increase. So again, we're at a bottom, and we expect rates to start to increase over time due to several factors that AJ will get into. And then finally, on the NGL side, there is now and continues to be a frac constraint. So this is something that we talked about very early in 22 when we released our NGL network model and put it out to market and had it available in our dynamic visual platform, Energy Data Studio. And one of the things that we were concerned with there was, hey, we have a lot of supply growing. We're filling up pipes, but there's not the frac capacity to take it. That's going to drive rates higher at fractionation units. And then, of course, we had the outage, the Medford fractionation outage that ultimately drove, accelerated what we thought would be more of a late year dynamic. It actually accelerated it earlier in the year. So we expect that to continue to be an issue, even though we have 700 million barrels a day of new capacity coming online. We still expect frac utilization to be high, and we also expect the growth in production is going to continue to drive supply into storage, start to fill storage coffers, put pressure on prices. And Ajay is going to go deeper into that, into some of the specific dynamics around there. With that, I'll dive into the gas side of the equation, and it's really overall the production side first, and then we'll jump into the supply side first, and then we'll jump into gas. And on the supply side, we have this historical frame of reference. Certainly what's dominated our mindset in the last few years from 2020 on has been, ESGs and capital discipline. And that's been a rally cry from across the industry, from across quite frankly, a global rally cry. And what we've seen more recently with the advent of Russia and Ukraine, and with a mindset towards future growth and rise of inflation and prices and all those things, is a bit more of a balanced approach towards our balanced thought process towards, hey, we want energy security too. We want growth from an industry perspective, and we need to do it in an ESG and a capital disciplined way, which the industry, especially from both the ESG side and capital discipline side, I think have responded pretty dramatically with new programs and new measurement tools. And capital discipline, as we see, many companies in an entirely different situation with regard to their cash flow. That has dramatically changed. We've become more efficient, but you can see from that chart on the right, which is rig counts across the various basins, that at a 30% reduction in rigs from 2019 to today, we are at levels of oil production that we were before, and we continue, and we've re-accelerated or gotten the momentum back from a gas production standpoint, where, in 17 to 18, we grew 10 BCF, and in 18 to 19, we grew 10 BCF. And then, we hit this sort of this pause in 20 with regard to the collapse in prices, and ultimately the collapse in the number of rigs that were active in the industry. But again, now we're back to 30% below where we were, and we're driving growth. And you can see the numbers there on the right-hand side of that chart, which shows the major basins where we're seeing that growth in the Eagle Ford and in the Permian and in the ArkLaTex, which ArkLaTex and Haynesville are the same for us. So if I say ArkLaTex, I mean Haynesville. When I say Haynesville, I mean ArkLaTex. So those are one and the same. So 126 total rig additions from last year, from the beginning of January to November 22, and that has ultimately driven higher production into the industry, which is quite frankly driving momentum into 23. And that momentum right now is carrying us towards the dynamic that I talked about, and we'll talk about in this next slide, that is creating a bit of an imbalance to where, we need to, as an industry, it's something the industry is going to be dealing with throughout 23. And what we're talking about there is, on the left-hand side, you can see in a green circle there's 4 BCF, almost 5 BCF of additional growth. And you can see that in the chart on the right there, that 1.8 comes from the Permian, 1.1 comes from the ArkLaTex / Haynesville, 1.2 from the Appalachian region. So that growth is coming from several major basins, several of which, including ArkLaTex, Appalachia, Anadarko. A lot of that is really gas driven, and that growth is going to lead to 5 BCF. The issue with that 5 BCF, and again, note this is exit to exit, so this is December to December. And that growth ultimately is something that we're looking at and wondering, well, how are we going to handle as an industry that amount of growth, that level of growth, when we don't have a significant new demand sources coming online? That will create a dramatic challenge for industry players who are both navigating the perception of the industry, which is prices could go down as a result of this in order to balance the market. So there's a perception there, but also looking towards a future growth potential of LNG, which ultimately is going to drive the need for all of that supply and more. I do want to note and reiterate that sort of end of year thing, because even Appalachia, if you look at that at 1.2, is a lot of that is driven by December to December dynamics. So it's a little misleading from a standpoint if we're looking at a December point in time to a December point in time versus averages year on year. So the numbers can play out a little differently. The other thing I want to note here, and I missed this in the last slide, but I'll reiterate it here, and you can see it in that table, the second table in the bottom, is we're actually forecasting a decline in rig counts. And we've been seeing that more recently into the end of this year. And we expect, based on the forward curve, we'll continue to see that decline in rig counts. But it's not just based on the forward curve, because again, at 5 BCF, we have concerns that we can absorb all of that supply. And so, quite frankly, we need to pull back in rig counts. And whether we do or not, that is a big question mark, but we do need to pull back in completions. So we could see rig counts stay high, but we start to build that DUC inventory that we've worked off over the past few years. We start to build that DUC inventory back. So again, it's something we're watching very closely because it will dramatically impact basis. It'll be interesting to see how the market perceives, let's say, a decline in rig count. When again, in actuality, as I look forward, the potential and the need for that supply is there. It's just misaligned with when the supply is coming online. We're riding the momentum from 22 into 23. If I jump to the storage and where we derive the conclusion of, well, why do we have too much supply? We put that into our natural gas supply demand balances, which we put out on a weekly and monthly basis and covering the markets, and then filter in each one of those basins, which you can see there on the some of the major ones listed on the right, although we have supply models for all basins across the United States. And the issue is when you put in 5 BCF of supply growth that trickles into the market over the course of the year, you get that dark blue line, which exceeds the red horizontal line, which is the theoretical 4 TCF storage capacity limitation that exists. Now, again, it's a bit of a fungible number, meaning is it 4 TCF? Is it 3.95? Is it 4.05? I mean, that's not something that I think we've ever nailed down or even tried to. But as you get close to that line, one thing we know for sure is the market starts to respond because there's less and less availability of storage in which to absorb our excess supply. And when you hit 5 TCF, that is way too far. So now if you focus in on that dotted line, there are opportunities to potentially see, last year was an exceptionally hot year. So we had high power demand, we had high industrial demand. If you start to normalize some of those, that is driven into our forecast. So could we see, another record year of both power and industrial demand? It absolutely could, and that would certainly pull down that dark solid line to closer to the dotted line. You could also see a further reduction in rig count, as you can see in that table on the right-hand side, where we further reduced rig counts by 10%. That could knock another BCF of supply offline, so also another balancing point. But again, a BCF of supply over the course of a year. And really, when we're talking about filling storage, we're talking about 3/4 of a year, not a full year, but nevertheless, a BCF over the course of a year, that's still only a third of a TCF, and we've got a whole TCF to knock out there. So the reality for us is that we expect that supply will have a harder and harder time as we go throughout the year finding a home, which will create pressures on supply because we'll see storage fill faster and faster. We'll see above average injection rates throughout the year, which ultimately will drive prices down and drive basis disconnects across the market. So it's a dynamic that'll impact how we buy infrastructure, how traders trade spreads, how they trade basis, how they hedge, how producers and traders hedge. So it's a dynamic that we think is extremely important for folks to watch and it's not a Haynesville thing or a Permian thing, or it's an everybody thing, because that's going to trickle around to the whole entire market as supply continues to push on every avenue it can to find a home. Just digging into the Permian real quick and talking about the dynamic there. The Permian actually has a bit of an exacerbated problem, which is it's growing. It's still growing fast. You can see here, we expect in those red lines infrastructure constraints for over the next 18 months. And what that means is, yeah, we've got El Paso's line coming back online. And to some extent, that's going to help supply, or that will help supply move its way into California. That will put pressure back on the Rockies. It'll put pressure back on Canada. So again, that sort of sponge effect where we're going to, poke in one area and squeeze out others. That's absolutely going to happen. We see the supply in the background to continue to fill those pipes late in the year. As you can see from the chart on the right, we've got Whistler and PHP coming online. But again, that doesn't happen till late in the year. And again, we expect those lines to fill up relatively quickly, especially if we're building DUC inventories. And you can see to sort of smooth that production growth, we've got a decent amount. It's a little hard to see in this graph, but certainly we can dig in on a one-on-one basis. But there's a red area on the top where we expect to see continued flaring in order to support that growth. To the extent that there's not continued flaring, I think that you could see impacts down on our oil curves, because all of this stuff is connected. So it's definitely something we're watching really closely. The other thing to note about this chart, and one thing we do, that dotted line is our proprietary look at what is the effective capacity to move out of the region. So it's easy to look at the rated capacity, which is that solid line. We prefer to look at the effective capacity because it helps us understand when basis is going to blow out, and ultimately when it becomes harder to find pipe open capacity to utilize. So it's an important dynamic to watch. There's also the aspect that Ajay will get into in a little bit when he talks about NGLs and the frac constraint I mentioned. To the extent that those frac constraints continue to be a problem, that just means more rejected NGLs that show up in the gas stream. And again, they're showing up in a gas stream that's already really full. So Ajay will get a little bit more into the NGL side of things. But just to hit the punchline here, we expect that Waha and the Permian in general will remain tight and pressured, and prices will remain pressured in Waha outside of what happens across the rest of the market. Waha will remain pressured for the next 18 months as producers look for a home for their supply. The other side of the equation, the ArkLaTex, again, also lovingly known as the Haynesville, we expect growth there. And again, this is an area that has some flex, meaning that it's a high growth area where that is driven by gas prices. And to the extent that gas prices continue to feel pressured, or producers continue to find a hard time finding a home, this is one of those areas where we could see some of that flex in, meaning reducing that 5 BCF of supply. Again, I will again note that only becomes options for the future in terms of filling the oncoming onslaught of pipes that are going to be built to move Haynesville supply into LNG markets, where we expect about 12 BCF of new LNG demand down on that Louisiana coast. That's going to need to be filled, and the Haynesville's in a prime position to fill that long term. In the medium term, though, there's that disconnect of where does all this supply go? Now, one issue that we're watching, and the chart, I should note the chart on the right there, that supply build begins with both Colombia's expansion there in late 22, as well as Gulf Run here coming online in early end of year 22 as well, or maybe mid early 23. So the reality, though, is those pipes are coming online to support that supply. And producers on the back end are building, this onslaught or carrying this momentum from 22 into 23 to build the supply levels. So if you look at this chart here, these are just using the average rig count that the top 5 operators in the Haynesville are operating in 22, reducing that in 23 to what you see on in the middle there, where you have Aethon going from 14 to 11, and then so on and so forth down the chart of those 5 top operators. You've got 1.8 Bs of supply coming online, feeding into a lot of it heading, or a lot of the top 5, Chesapeake, GEP, all going into Williams, DTM getting a decent amount of Southwestern, Comstock heading into Energy Transfer. So these producers are producing an excessive amount of supply. And again, we don't have to, let's say, forecast or look at, try to pontificate on expectations. We just need to run the rig counts they're running right now into the future. So, and that already generates 1.8 BCF supply growth in 22 to 23. So a huge boost in the level of production coming out of that market to feed pipes like Gulf Run through these G&P facilities that you can see listed here on the very far right side. And sort of aligns to, and I think in the greater deck, we talked to some of the growth expectations, the additional processing capacity Williams has added. We see a lot of those systems being primed to fill, and so these are just sort of bullet points or verification facts that indeed the supply is there. And again, we're looking at the demand side of the equation and asking the question of when it's going to show up. And really, again, reality is we expect most of that will show up as LNG comes online. Just to dig a little bit deeper into the ArkLaTex, and in particular the Haynesville, which we have circled there in that green area where it talks about core production, and that's where a lot of the activity is happening. You can see some of that can spill, or there's a potential for some of that to spill over into East Texas, which we talk about in greater depths within the greater presentation on DLS, as opposed to this executive summary. But you can also see this expansion there in the right-hand side of our Northwest Louisiana South route. So this is different from the Perryville down south route, but more Northwest Louisiana South down into Gillis. And what's really interesting, or I find fascinating after working in this industry for as many years as I have, is, this is akin to the infrastructure we saw built out in the Haynesville in 2008, 2009 timeframe, as it was responding to the massive growth we saw there, or akin to the Marcellus expansion. There's a lot of productivity and possibility and potential here in the Haynesville to grow and continue to support our long-term demand needs on the LNG side. With that, I will dive in a little bit to the LNG. You can see just this massive ramp in total LNG capacity that happens over the course of the next really from 25 to 30, because you do want to focus, and we could put some horizontal lines here to sort of dictate that. But as you see some of the near-term volatility there with the squiggly line of total export forecast against the historical stuff, and then you see a bit of a flat line before you start to get Golden Pass come online and start to ramp the demand levels in 24. But and then going forward, but even until then, it's a very moderated. Again, it's kind of hard to see in this graph, but it's not a huge growth prospect, and we're sort of waiting for that huge ramp to come, which it is coming, and that's the expectation we have going forward, is that it is coming, and people should look for that for making their current decisions in support of, with the expectation of this long-term demand outlook, meaning, hey, if there's investment opportunities now, take them, because when this ramp starts to happen, it moves very, very fast, and the need for that supply growth, like we're seeing this year, becomes extremely accelerated. So again, we've got a lot of growth here. You can see, again, over 12 BCF of Louisiana. We've got a number of expansions down on the Texas side, which, again, we get into more detail within the report itself, within the larger report of talking about Agua Dulce, and an area where we expect that to be long initially, but then be short and needing excess supply and likely excess new infrastructure to support that LNG growth in the long term. So those are opportunities for folks, investment opportunities. In the near term, they could be, their basis issues that we're going to have to deal with. So the last slide I want to get into before we jump into AJ and talking about crude is just this SPAs. We've been tracking the agreements that various parties are making with LNG facilities. We continue to see a ramp, as you can see in this chart there, where we've got the stacked area of the different SPAs, the total cumulative SPAs that are being signed. So that 17.5 BCF of new capacity that's on its way, a significant amount of that is already contracted, and so it's not a mystery of whether or not these facilities are being built, because many of them are starting to announce FIDs, or at least starting to get some real momentum on getting enough contracting to announce FID. And going forward, we expect that they will continue to do that. It does remain, I think one major question we always look at or are contemplating is the utilization. Historically, we've seen high utilization from these LNG facilities, and we don't really have any reason to believe that there won't continue to be high utilization. But it does present, as we saw with Freeport this year, a lot more opportunity for volatility within the market, because when you have 25% of your market, demand market, meaning we get total LNG to over 30 BCF in a U.S. demand market that's going to be roughly 120 BCF. We'll have 25% of that pinned towards LNG, and therefore, to the extent we have outages where 2 BCF facilities go out, then you're going to see some volatility in the market as the market looks to manage that, those sort of outages and maintenances. So with that, I'm going to transition over to AJ, who's going to dig into the crude markets and talk about some of the dynamics there.
Thank you, Justin. As he said, my name is AJ O'Donnell. I'm a director here at East Daley. I'm going to talk to you about crude markets today. And I just want to remind everybody briefly, if you guys have any questions, please submit them to that Q&A box. We're going to leave some time at the end. I only have 4 slides to go through today, so we're going to try to keep it short and concise, and then leave some time for Jay to talk about NGLs. So as Justin laid out for his gas production outlet, a lot of it predominantly stems from associated gas from oil-focused basins. So I want to focus on what the underlying crude assumptions look like and how it will affect Permian egress, the egress landscape in the coming years. We see U.S. lower 48 crude production growing by more than 2 million barrels exit 21 to exit 23, which will surpass pre-COVID highs set in December of 2019. And all this is done with a lower rig count, which highlights some of the drilling efficiencies that we've seen in our well data, mainly higher IP rates as a result of longer laterals and lower spud-to-spud times. Now, the Permian plays a key role in our production outlook in making up about 74% of our total lower 48 estimate, or about 1.5 million barrels per day. The remainder of the gross will come from other liquids basins such as the Eagle Ford, Bakken, Anadarko, and the Rockies. Before getting into the key takeaways on our crude outlook, I'd like to highlight the differences in our outlook versus midstream operators like Plains and Enterprise, who also publish Permian forecasts. So if you look at the top left graph, it's clear that we have a different shape to our production curve than, say, EPD or Plains. Ours is much more short-term loaded, which is a result of those producer efficiencies I just spoke of, mainly higher IP rates, while EPD and Plains have a higher tail assumption. I think the differences in our long-term outlook largely reflect our view on declining rig counts due to the backwardation of the WTI curve, which we correlate our rig activity to, some of our rig activity to. I believe both Plains and EPD are assuming a flatter rig scenario. Regardless whether you trust our forecast or Plains or Enterprise, the medium to long-term story will lead you to the same answer, which is egress out of the Permian is going to tighten. The question is just at what speed will it happen? So where will all the growth go? Well, if we look at it, it's unlikely a lot of it, some of it, but not a lot of it will go north to Cushing, even though there are some mid-con refiners that create sticky demand for Permian barrels. Prices and spreads now and throughout the forward curve are not conducive to attract marginal barrels. Instead, we allocate a majority of incremental Permian production headed directly to the water. So this is via Corpus or Houston. Over the period of 2019 to 2021, these were the routes that out of the basin where capacity was added, approximately 4 million barrels of egress capacity to be exact. Corpus was the first one to bring on new egress capacity, which allowed it to win much of the incremental production, as well as displace some of those barrels headed north to Cushing. So, however, in our long-term outlook, we assign more future growth to Houston, which is mostly due to ramping commitments on the Permian's biggest pipeline, Wink to Webster. In total, as of today, we're sitting at approximately mid-70% utilization rates, but that will quickly rise to 90% in the coming years as production grows. This is, right now, this is our base case assumption. And then the only other thing I wanted to call out was a Permian flat rig scenario, which more closely resembles the outlook of Plains and Enterprise. And this is represented by that light shaded area at the top of the stacked area graphs. Under this scenario, it's no surprise, pipe directly to the water fills at a much faster rate and actually runs out. At which point, we need to start thinking about expansions, likely brownfield expansions, or if there are no expansions, Midland will have to significantly discount to WTI in order to incentivize barrels to flow north out of the basin. So if we tie this all together, there's kind of a perfect storm brewing for midstream operators in the coming years, which is much less of a dire outlook than we had a couple of years ago. So if we think about the current rate environment, it's not great. Spreads are tight between key pricing hubs right now, and heavily discounted incentive rates have driven down the average transport rate across the basin. As a pipeline operator, this is not the type of environment you want to be signing new long-term contracts in. However, this will change, and I'll lay out a couple of reasons why. Let me just fast forward to this. First, we start to see if you look at that top left graph, we start to see major contracts roll on key egress pipelines beginning in 2024 through 2026. At the same time, we have pipeline utilization rates pushing above 80%. As utilization pushes upwards, forward curves will widen, which we're starting to see in the data. If you look at our full DLS graph, we actually have a slide on this, showing where forward curves are today versus where they were a year ago. And this is just indicating that the market's starting to rationalize some of this oversupplied capacity that we've added over the last few years. So as prices widen And as more shippers are looking to recontract firm capacity, we'll likely see competition for egress out of the basin start to heat up. At the same time, we anticipate these cheap incentive rates will likely be phased out, and there's going to be a higher portion of spot barrel shipments, which is reflected by that blue shaded area in the top left graph, which typically move at much higher rates than committed service tariffs. At the same time, we have inflationary pressures from annual FERC tariff rate increases, all to the benefit of the average transport rate out of the basin. So as a pipeline operator, the road ahead looks fairly decent in the next 2 to 4 years. And this is really the key takeaway behind our call for transport rates out of the Permian bottoming. That's all I had. I'm going to give it over to Ajay, who will talk about NGLs.
Thanks, AJ. So onto NGLs. The theme with gas and crude so far has been production is growing, even with lower rig count expectations. And as you can see on the left chart, that also applies to NGLs. And as with crude, most of this growth is coming from the Permian, which will be relatively unconstrained from any pressures around oversupply on the gas side. Stable rig activity, efficiency gains, higher GORs, and higher ethane recovery due to gas egress constraints will continue to push NGL production to new highs. With that being said, there is some downside risk to our production forecast if flaring comes in even higher than expected, as flaring will burn NGLs at the wellhead, or at the opposite end of the spectrum if producers actually start shutting in wells to avoid flaring. Now, moving to the right chart, let's take a look at the other side. Take a look at the other side of the equation, which is demand. Demand has also been booming for the last decade, really, and projections expect continued growth through 2028. However, a lot of the projected demand growth has already occurred, and right now there's only one ethane steam cracker plan that will be online around 2025, 2026 from Chevron Phillips. So in order to keep pace with supply growth, more and more NGLs will need to be exported, and NGL infrastructure will be focused on ensuring that domestic supply can meet international demand. This has been an ongoing trend, and we expect that to continue going forward, as that's where most of the demand growth for NGLs will come from. Currently, NGL exports are dominated by a select few, Energy Transfer, Enterprise, and Targa. As you can see on the charts, Enterprise and Targa are the only companies with ethane export capabilities. Enterprise and Energy Transfer are the only ones with ethane export capabilities, while them and Targa own the vast majority of the LPG export capabilities. There's still sufficient capacity remaining for both ethane and LPG exports, as you could see, which might make it hard for a new entrant, but it is an area that is growing tremendously fast. There are still new facilities coming online internationally, especially in China, but we still expect exports to be relatively flat through 2023 as global utilization rates have come down back on the back of recession fears and lower demand. The ramp up or startup of any new facilities could also be delayed as petchems right size that supply and demand. Overall, we expect more NGL midstreamers will want to have their hands on this NGL barrel from wellhead to water, and we've seen Targa and Enterprise go up the value chain to boost their G&P presence in the Permian, which has also led to subsequent expansions to their NGL pipelines and fractionators. There's also this opportunity to go down the value chain and try to get a piece of this increasing export pie. Similar to what Justin said about LNG, we might not see much growth in 2023, but the long-term trend still persists. Now, exports revolve more around NGL purity products, what happens after the frac. However, there's also significant constraints before and at the fractionator as well. You cannot export unfractionated Y-grade, so these constraints matter to downstream markets as well. We've been projecting fractionation constraints for some time now, but the explosion at One Oak's Medford fractionator was a catalyst to really get things tight. We expect frac utilization, which is the dotted red line on the chart, to remain above 95% through 2024. And this is even after 700,000 barrels a day of new capacity is being added from the likes of Phillips 66, ONEOK, Enterprise, Energy Transfer, and Targa. Now, fracs can run above 100% utilization in the summer months, but historically, they've not sustained such high levels of utilization without eventual maintenance or turnaround periods. So frac constraints could actually worsen even more as capacity needs to be taken offline for maintenance. To get utilization back down to 90%, we'll need another 500,000 barrels a day of capacity added. So this is in addition to the 700,000 barrels a day that's already being added over the next 18 months. So if there are so many constraints, why aren't midstreamers just building more fractionators? Well, that may come back to exports and international demand. Midstreamers at Mont Belvieu will, they want customers to help underwrite new fractionators, and the delay in doing so could reflect petchem buyers being more cautious to commit to more supply in this uncertain demand environment. Now, what's the effect of these fractionation constraints? Y-grade inventory builds. Remember, Permian egress gas is constrained, so it's hard to just reject ethane right now. And then you have ESG concerns against flaring that still exist, so there's going to be less willingness to just flare the NGL like we have in the past. And that really only leaves one option, which is storage. Now, since the constraint is at the fractionator, all the storage is going to be in the form of Y-grade. So we like to use weekly propane and propylene inventories, which includes an estimate of the propane held in Y-grade, as sort of a proxy for what Y-grade storage is. And as you can see on this top chart, it has shot past from 5-year lows to 5-year highs in the last 6 months. And it's still been persistently increasing, even heading into the winter heating season. Now, remember, again, this is before the fractionator, so one would think that this should increase purity propane prices since it's limiting supply. However, the lower demand from declining petchem utilization has already started impacting LPG prices downwards as a percentage of WTI, and you could see that on the bottom chart. However, eventually this propane that's still left in Y-grade will need to be fractionated, and when that fractionation constraints ease, you're going to have a lot more propane flooding the market, which is going to create additional downward pressure and could keep prices down even as some export demand returns. Historically, looking at the blue area on the chart, inventories have trended below or above the 5-year average for about 12 to 18 months at a time, and prices shown by the red line have corresponded to being 50 to 70% when below and 30 to 50% when above. Based on recent data, however, we've been seeing it entering a trend of above 5-year inventories, and the forward curve, however, is only at about 45 to 50% still for LPG prices, when before it's reached as low as 30%. So it happened in 2015 and 2019, and we expect a similar scenario heading into 2023. So that brings us to the end of our presentation, and we want to thank everyone for joining and for your interest in Dirty Little Secrets. Again, we will be doing a Q&A, so just feel free to submit any questions that you have. As a summary of our conclusions, one, we expect gas prices will need to decline in order to incentivize gas-centric producers to reduce production. At current levels, we will blow past storage capacity, and we see the ArkLaTex and Anadarko as the most likely areas to adjust production, given those producers are the most sensitive to gas prices. In the Permian, we expect Waha to face continued pressure for the next 18 months as egress constraints will exist until Matterhorn comes online in late 2024. Additional maintenance that takes any capacity offline could result in negative prices and hurt producers and midstreamers who are selling in-basin gas. crude pipes out of the Permian are filling up, and we're calling for a bottom for utilization and rates on those assets, especially with increasing international demand. We see Permian pipes to the Gulf Coast filling up and increasing that basis between Midland and Houston. And lastly, again, the current NGL commodity environment will also impact producers and GMP assets exposed to commodity prices, as fractionation constraints and storage increases will continue to pressure prices going forward. And with that, we'll give everyone a few minutes to submit a few questions, and then we'll get on to answering them. Thank you.
I'll take one question right off the bat here, Ajay, that I see coming in. Again, please continue to submit your questions to the extent you have them, is regarding processing capacity. And, when you look at processing capacity at a high level, and I think if you look at from a holistic standpoint, it's pretty easy to see that there's plenty of capacity in, let's say in the Permian, for instance, from a growth perspective. What's more interesting, and the way we prefer to look at it, is to actually dial it into a system by system look to see, where our capacities, where could there, more micro constraints, and really connecting supply growth with the processing facilities that will process that gas that ultimately connect to the pipelines, both NGL and gas, that will take it away. And at a local level, we've seen an immense amount of build in the last year, and announcements for new capacity. I think somewhere between 2 and 3 BCF. I don't have the number off the top of my head, of new capacity being built in the Permian, which again leads me to believe, and again at a system level, what we've been seeing is those facilities filling very, very quickly, and we forecast each individual system, so ET system, Williams system, One Oak system, et cetera, so on and so forth. I think we have over 300 systems that we forecast. Those systems are a lot of those systems are filling. We see them adding capacity, which at this point is sufficient to continue to grow. Again, especially in light of the fact that we kind of are looking at restricted supply, or would expect some restricted supply, or building of DUC inventory. And then again, I mentioned it in the Haynesville, but Williams is doing a number of expansions to support growth there. And as we talked about in the presentation, number of producers that continue to have a sufficient rig level to drive production higher out of the Haynesville. So again, on the processing side, there is sufficient capacity today, and we expect there will continue to be more processing added over the future to support that growth in the market.
Justin, I'm going to take one on the crude side, and this comes from about SPOT and its implications for our Houston versus Corpus outlook. If you're not familiar with SPOT, SPOT is Enterprise's Seaport Offshore Terminal, which is a crude export facility located about 30 miles off the coast of Houston. This facility is capable of loading VLCCs at a rate of 2 million barrels per day. And if you look at our East Daley's crude hub or crude network model, we have demand stacks or export stacks for each of the hubs. And really, we have plenty of export capacity at each of these hubs, and plenty of room to grow into incremental supply from the Permian and other liquids focused regions in North America. So we don't really need it, but it's definitely going to make competition between the two major export locations, Corpus and Houston, heat up. There's probably risk to barrels that are currently being exported out of facilities in and along the Houston Ship Channel, of which Enterprise, ET, and PSX have a stake in, as well as volumes above contract levels at Corpus could be at risk. Because a new offshore facility like this is going to be advantageous from a location standpoint, likely facing much less congestion in and along the Houston Ship Channel, and probably able to offer very competitive rates just from a economies of scale standpoint.
I have another question coming in. Which midstream operators stand to gain or lose from tighter takeaway? And the immediate ones that come to mind here would be Energy Transfer and DCP. We've seen Energy Transfer make a lot in terms of natural gas marketing, especially when that Waha, when Permian egress is tight, upwards of, $200-300 million a year in EBITDA even. And so I would expect them to still have the space to take advantage of that spread. And then DCP on their Guadalupe pipeline as well. The earnings on that pipe especially tends to correlate with tight egress and wide spreads at Waha.
Yeah, I think there's a couple of questions here on prices in general and basis markets, and so I'll just try to field these. I mean, we're working on a more expansive and in-depth study of how basis and prices will transpire over the next few years, quite frankly, because as I said, it's going to be a wild ride and a bumpy ride. So I'm going to hit this at a very high level, but to the extent that you're interested in digging in real deep, please reach out. We'd love to share that with you as soon as we quickly put it together in a really cohesive way to explain how it happens. But nevertheless, as you see, this Haynesville infrastructure come online, my expectation currently is that it's going to put a lot of pressure on, and you've got this supply pressure backing that. So understanding that supply pressure, then it will put pressure back on, in particular Texas. It's going to put a lot of supply pressure back in Waha. A little bit of pressure if you see Columbia Gulf and some pressure into Henry Hub. So you'll see outright fixed price feel that pressure, but potentially even greater pressure on the surrounding areas, meaning other basis markets, which again then will trickle back into, if you start to push pressure on Houston Ship Channel, that's going to reverberate back into Waha. It's going to reverberate up into Chicago. It's going to hit all the way back into ACO, and that's going to change the spread dynamic between let's say Columbia Gulf Mainline in northern Louisiana and the Northeast as well, because you're going to have to start pushing back on some of the supply that's coming down there to the extent you can't find a home for it. And so that's going to kick around the entire market, and you're going to see that trickle effect. And then you're going to get, Permian start to open up, and some later of 2023 pipes open up, which dumps a bunch more supply into Houston Ship Channel. And ultimately, Matterhorn's going to come online in 24 and another 2 BCF supply. And that's, again, where we start to see some of that dislocation between potentially where, Houston Ship Channel is and even Agua Dulce, as you start to get, demand growth down in that market and not the capacity to facilitate or to meet that demand needs. And also potentially a disconnect where, do you see Henry Hub start to rise dramatically, flip from going down to then flip to going up as you bring on new facilities that need additional supply and additional capacity to get there. And again, it's all going to be based on timing and going to be a really interesting roller coaster as shippers, producers, demand markets all respond to that shifting, those shifting dynamics. So again, there's more to come on this. I'd encourage you to reach out if you want to dig really deep into that, because there's a lot going on with respect to new pipe, new infrastructure, supply growth, and demand side dynamics. So there's a lot there. I often get the question, I don't see this in the chat, but I maybe want to hit this because I get the question about frac constraints and, local supply constraints. And certainly I know those exist out there. In my opinion, it's probably, at least in the near term, given that we need to reduce supply, a frac constraint is probably, not as impactful for the market because it sort of helps, right? If you don't have the frac crews to complete the supply, it sort of helps with the issue of how do we balance supply. Well, frac crews kind of did it for us. Again, long term, I think that's going to be a major industry issue for the industry as we talk about supply growth to meet 17 BCF of LNG demand needs in the future for NGL demand and crude demand, et cetera. Like having those crews available to meet those future growth needs is going to, that's going to flip from not being as big a deal now to being a huge deal in the long run. And unless we see major changes in efficiencies, in order to support that growth, which I'm a believer in technology, so we absolutely could see some of that happen. That will be a big constraint that will drive the future of supply availability in the U.S. Is do we have the crews? Do we have the pipes? I think will become another issue. One thing I didn't talk about, we talked about this in detail last year, and I know I'm a bit rambling a bit, but we talked about this in detail last year, and I want to reiterate it is long term, it's not just the Haynesville and Permian that can support 17 BCF a day, which presents opportunities to make investments now in basins like the Anadarko, in the Rockies, in the Eagle Ford. Make investments today that likely won't pay off today or tomorrow, but to feed that long-term end of decade demand surge, there's going to need to be support from other basins to balance this market, and so those areas present prime opportunities for investment in acreage and investment in infrastructure. We don't necessarily have the pipes to move that kind of growth out of the Rockies and out of the Anadarko. So again, those are huge opportunities that I think are worth spending some time now to figure out what are the investments we want to make now to support the demand needs of tomorrow.
Right. With that, we will be closing Q&A. Again, thank you for attending and for your interest in Dirty Little Secrets 2023. Replay plus these slides will be available after the call. You can also get the full DLS 2023 report that explores these topics even further by registering at our website. If you have any firewall issues and cannot download it from there, just reach out to sales@eastdaily.com. And as Justin said, if you have any questions or would like to explore any of these topics further one-on-one, again, just don't hesitate to reach out. Thank you.